Today we shall start our discussion on leasing and hire purchase. First let us take up leasing, then we will go to hire purchase. Leasing is defined as a contract between two parties whereby the owner of the asset transfers right of use to some other party on payment of a fixed periodical interest. That means there is a owner of a property of an asset and there is another person who wants to use that asset. So the one party transfers the use of the asset to the other, and in return the other party which is using the asset pays a certain sum of money to the owner of the asset, that is called a periodical rent. So based on this definition we can decide as to what are the features of a lease contract. As you know, there are two parties to a lease contract, the owner of the asset and the user of the asset. The owner of the asset is called the lessor and the user of the asset is called the lessee. So lessee gets the right of uninterrupted use of the asset provided he makes payment of lease rent regularly. That means once the asset is given to the lessee, he has the right to use that asset without any interruption provided he makes payment regularly as agreed upon, and this payment of periodical sums is known as the lease rentals. So lease rentals are required to be paid regularly by the lessee to the lessor. So during the period of the lease, the ownership of the asset remains with the lessor only. That means lessor continues to be the owner of the asset, though the asset is being used by the lessee. Normally the contract is for a specific period. It could be a few years or a longer period also, depending on the type of asset and the type of agreement between the lessor and the lessee. On expiry of the contract, it may be either renewed or terminated depending upon the terms of the contract. Normally, many of them may provide for renewal of the contract for a further period or even sale of the asset to the lessee after the expiry of the lease period for a certain sum of money. That is again a matter of contract between the two parties, that is lessor and the lessee. So let us now try to understand what are the advantages of lease in terms of both the parties. First let us consider the advantages to the lessor. One is he can expand his business. That means even if the assets are of no use to him, he can still buy the assets and give it to somebody else for use of the asset, so that he can make use of the money he has at his disposal to expand his business. And it also becomes a very good tool for tax planning, because as owner of the asset he is entitled to take depreciation on the assets, and in addition to that he will be getting lease rentals from the lessee. Therefore it is a good measure of tax planning. Therefore these are the two important advantages for the lessor. As far as the lessee is concerned, there are certain advantages. One is reduction in capital investment. That means lessee is not required to bring any money, particularly in respect of those assets which require heavy investment. He can straight away lease the asset and start using. So without even having to invest large sums, he can start his own business. That is one of the most important advantages to the lessee. Second is the elimination of risk of obsolescence. If the asset being used is prone to becoming obsolete faster, which happens in the case of technologically advanced assets, in such cases the risk is not with the lessee. That means as soon as the asset becomes obsolete, he can return the asset to the lessor and he need not bother about the money invested in that particular asset. So that eliminates to him the risk of obsolescence. And third is the increase in borrowing capacity. Since he has not invested any money, he has got a lot of scope for borrowing further for expansion of his business. And next is reduction in tax liability. As the lease rentals paid by the lessee to the lessor are tax deductible, that means they are eligible for deduction before arriving at the profit before tax. They become tax deductible expenses, and hence that will reduce the tax liability of the lessee and less dependence on financial institutions. Since he is not required to invest any money, he need not go in search of raising either loans from the financial institutions or raising equity. Therefore, he doesn't have to depend too much on the financial institutions and banks for his borrowings. Now, let us look at the limitations of the lease transaction. One is, lease rent may be quite burdensome to the lessee as it includes the cost of finance, depreciation and administrative expenses of the lessor. Normally, there is a lessor, since he is investing money in the asset, what he does is he has to take care of the interest on the asset, that is cost of finance for getting that asset, plus he has to take into account the depreciation of the asset, that is because of wear and tear and other things, and also his administrative expenses. This naturally he would pass on to the lessee. Therefore, the lease rentals may become quite burdensome on the lessee. In case the leased assets are acquired by lessee by borrowing from banks, any default on the part of the lessor may adversely affect the operations of the lessee. In case the lessor has bought these assets on loan from the banks, then in the case of default by the lessor, the banks may try to take hold of the assets, in which case the operations of the lessee will get affected. So, to that extent, it is one of the limitations of the lease, or as far as the lessee is concerned. And the demand for finance remains the same, as leasing only shifts the need for borrowing from lessee to the lessor. In case there was no lease agreement, then the lessee would have gone and taken a loan from the banks, and since he is getting the asset on lease, here the need to take a loan will be shifted to the lessor. But as far as the economy or the country in general is concerned, there is no reduction in the need for borrowing, because the need only gets shifted from the lessee to the lessor. And leased assets are not eligible for capital subsidies available for projects in backward areas. As you may be aware, Government of India, in terms of its industrial policy, wants to encourage industries in backward areas, and for that purpose they normally give capital subsidies for any investments made in capital assets in those backward areas. But if the entity takes the assets on lease basis, then that entity will not be eligible for any capital subsidy, in which case most of the entities who would like to set up businesses in backward areas may not be interested in taking the leased assets. And finally, lease rental structures normally do not provide for maintenance period. What it means here is, the rental is so structured that it does not take into account the maintenance required of the asset. That means that will be entirely to the cost of the lessee. Normally, lease rentals do not include such maintenance expenses. Now, let us try to find out the various types of leases. So, there are mainly 4 types of leases. One is called the finance or capital lease, second is called the operating lease, third is called the service lease, fourth is called the leveraged lease. Now, let us discuss each one of them in detail. Let us first start with the finance lease. Finance lease is the most popular type of lease. It is long term in nature. Generally, the entire economic life of the asset is agreed to be transferred for use by the lessee. The economic life of the asset is the useful life of the asset. If the asset is useful for a period of 20 years, normally the lease agreement provides for use of the asset by the lessee up to that period. So, normally it will not be returned to the lessor. Secondly, lease rentals in total exceed the cost of equipment. Here, the lease rentals are so structured that it will always exceed the cost of equipment, because the lessor has to recover not only the cost of the equipment, but also the finance charges on that, plus depreciation, plus all other administrative expenses. Normally, such leases are non-cancelable during the primary period. Normally, the entire period of contract is divided into 2 periods. One is called the primary period, the other is called the secondary period. Primary period is normally large enough to take care of the life of the asset, and therefore, the lessee cannot return the asset during the primary period. That means, whether or not he needs the continued use of that asset or not, he has to continue to pay the lease rentals to the lessor. Lessee bears the risk of obsolescence. Here, we were earlier considering normally the risk of obsolescence is the lessor, but in the case of a finance lease, the risk of obsolescence gets transferred from the lessor to the lessee. And lastly, the lease rental during the secondary period is normal. Here, after the primary period is over, normally there is a reduction in the lease rental, that will come back to normal. Then let us talk about the operating lease. Operating lease is defined negatively. It is a lease which is not a finance lease. That means any lease which does not have the characteristics of a finance lease, as we discussed earlier, is called an operating lease. Therefore, it is usually cancelable and has got a lower maturity period, unlike a finance lease which is normally not cancelable and has got a longer maturity period. Normally, such type of operating leases are in the use of assets like telephones, vehicles, computers, etc. are taken on operating lease. That means whenever the lessee wants to return the asset, he can return the asset, and rentals are not normally high and they can be cancelled at any time during the period of the lease. Then come to the third type of lease called the service lease. This covers the cost of maintenance and servicing the assets for a short period. As the name suggests, it is only a service lease. That means only the service contract is undertaken and it only takes care of the cost of servicing and not the capital outlay. Normally, a lot of assets need regular servicing, particularly technologically advanced assets. Therefore, this service lease takes care of providing service at periodic intervals on the asset which is being used. Then finally, the fourth type of lease called the leveraged lease. There are three parties in such a lease, unlike a normal lease. Here the third party is the financier to the lessor, and this is also therefore known as a third party lease. So it works like this: there is a financier who finances the asset and the lessor buys that asset by taking finance from the financier and then leases it out to the lessee. And there is an agreement between the financier and the lessor, and similarly an agreement between the lessor and the lessee. And since it is based on the finance from a third party, it is called leveraged lease. Leveraging means normally taking on debt. Therefore, the name leveraged lease. Now, let us go to the accounting treatment in the case of a finance lease. And this accounting has to be done both in the books of the lessor as well as in the books of the lessee. Let us first consider the accounting treatment in the books of the lessor. Here, in the case of a lessor, assets given on lease should be disclosed under the head fixed assets in the balance sheet as assets given on lease. So, in order to distinguish between the assets which are used by the lessor himself in his own business as distinct from the assets which he has given on lease, there is a separate column introduced under the fixed assets known as assets given on lease. And all such assets, depreciation will be charged and they will be shown at their written down value. That means depreciation is based on WDV method, and as at the balance sheet date, the lease assets will appear at their written down value. So, whenever annual lease rent is received by the lessor from the lessee, that accounting entries to be put through our bank account debit to lease rent account credit. That means the money is credited to the bank account by the lessee. Therefore, in the cash book of the lessor, bank account will be debited and lease rent account will be credited. That lease rent account becomes an item of income for the lessor. Then thereafter, whatever is the annual lease rent collected in that account should be transferred to P&L account at the end of the year. So, the rent could be received even on monthly basis or even quarterly basis, in which case such entries need to be passed periodically, and at the end of the accounting year, the entire income under the head lease rent account will be transferred to P&L account and that account will be closed. Accounting transactions in the book of lessor only, we will continue what happens in respect of other things. One is against the annual lease rent, a matching annual lease charge should be debited, because the annual lease rent takes into account depreciation and other items. Therefore, a separate annual lease charge is created and it should be debited, and it is defined as under annual lease charge is equal to annual lease rent minus finance income allocated to each year. That means whatever is the finance income on account of interest on the cost of the asset is allocated to each year, and that has to be deducted from the annual lease rent. And the finance income is calculated as under, first of all you have to take the total annual lease rent for all years, plus add to it the residual value of leased asset, that is called the scrap value of the leased asset, minus the fair value of the leased asset at the beginning of the lease term. So this will give you the finance income that has to be distributed or allocated over each period of the lease term, either by a straight line method or the sum of the digits method. Either of the method can be chosen. Then again annual lease charge is bifurcated into two elements. One is called statutory depreciation provision and second is called the lease equalization charge. So in respect of all these, this is how the entries are passed. In respect of depreciation, we have to debit the depreciation account and credit it to the leased asset account. And lease equalization charge, what has been separated, is also debited to the lease equalization account and it is credited to lease terminal adjustment account if the annual lease charge exceeds depreciation, or if it does not exceed depreciation, if it is less than depreciation, then lease terminal adjustment account is debited and lease equalization account is credited. And in respect of commission and legal fees account is debited and bank or cash account is credited. This is commission and legal fees incurred by the lessor in respect of the lease transaction, and whatever managerial fees, service charges he receives from the lessee, they are again debited to the bank account and credited to service charges, management fees account, which becomes an item of income for the lessor. Now let us consider the accounting treatment in the books of the lessee. First of all, lessee has to pass entries whenever he pays lease rent. So lease rent account is debited whenever lease rent is paid by crediting the bank account, and at the end of the year, whatever lease rent is been paid, accumulated in that account, is transferred to the P&L account by debiting P&L account and crediting lease rent account. That means it goes to the debit side of the P&L account, which means it is an expenditure in the books of the lessee. If any lump sum is paid for acquiring leasehold property and the payment is not in the nature of prepaid lease, such lump sum amount must be written off over the period of the lease. For example, in some cases, the lessee is required to pay a lump sum amount, and the lump sum amount has to be taken in respect of each year separately. That means, as it belongs to several years, only that portion which is attributable to that particular year has to be taken. Therefore, in such cases, the following entries are passed. One is called the leasehold property account debit and credit bank account for the lump sum amount. That is the first time when the payment is made. After that, profit and loss account is debited and leasehold property account is credited. This is the amount written off every year. That means whatever amount is lying in that leasehold property account is written off over a period of time. If the lease period is, let us say, 5 years, then 20% is written off every year. If the lease period is 10 years, about 10% is written off every year. And in the case of operating lease, let us consider what are the transactions which have to be put through in the books of the lessor. In the case of lease being less than for a year, that means the period of lease is less than a year, then the bank account is debited and lease rent account is credited. And finally, at the end of the year, lease rent account is debited and the amount transferred to P&L account. It becomes an item of income in the books of the lessor. If the lease is more than 1 year, but the lease's rent is fixed at a certain amount per year, the same entries are required to be passed in the books of the lessor. And where the lease rent is, lease is for more than a year, but the lease rent is fixed as a lump sum figure, then a different sort of accounting has to be followed. As soon as the advance lease rent in lump sum is received, it is bank account is debited and the advance lease rent account is credited. That becomes an item of income, but it does not pertain to only 1 year. So at the end of the year, certain adjusting entries required to be passed. So for that purpose, what we do is that account is again debited, that is advance lease rent account is debited, and only that portion of the lease rent which is attributable to that year is credited to the lease rent account. So that lease rent account becomes the income of the lessor for that particular year. So apportioning a portion of the advance has to be done based on some parameters. If the lease period is, say, let us say for 5 years, then the 20% of the advance which is received can be attributed to the year. And depreciation also has to be accounted for. For that we pass the entries as depreciation account debit and to asset on lease account credit. That is the amount of depreciation charge on that particular asset. And if there are any expenses incurred in maintaining the leased asset, then expenses account has to be debited and bank account is credited. That becomes an item of expenditure in the books of the lessor. Again, if the lease rent is received in various installments. So the first situation is where the lease rent is received in lump sum, and the second situation is the lease rent is receivable in various installments, in which case what he has to do is he has to debit the lessee's account and credit the amount to lease rent suspense account. This is the total lease rent receivable from lessee. That means he has to calculate what is the total amount to be received over the life of the lease, and then the entire amount is kept in a lease rent suspense account. And as soon as 1 year's lease rent is received, then this lease rent suspense account is debited and that amount is credited to lease rent account. So that lease rent account becomes the income of the lessor for that particular period. And finally, when the installment of lease rent is received, then you have to debit bank account for having received the money in the bank account, and lessee's account is credited. Now let us consider the accounting treatment in the books of the lessee. The first situation is lease rent is fixed at a certain amount every year. Then lease rent account is debited and the bank account is credited. That means lease rent is transferred to the lessor by treating it as an item of expenditure. When the lease rent is fixed as a lump sum to be paid in installments, then lease rent suspense account is credited here, debit. That account is debited because that becomes an amount which has to be paid, and lessor's account is credited at the beginning. So as and when current year's lease rent is required to be paid, then lease rent account is debited and the lease rent suspense account is credited. That means you go on reducing the balance in the lease rent suspense account by the amount of the yearly rent payable to the lessor. And when the actual payment is made, then lessor's account is debited and the bank account is credited with the amount of lease rent passed on to the lessor. Now we will go to the second part of this, known as the hire purchase and installment sale. This is slightly different from the lease agreement. Let us try to find out what is the meaning of this, what is the difference between hire purchase and installment sale. Both, though appear to be same, they are slightly different from each other. Then we will finally come to the various accounting entries that need to be passed, both in case of hire purchase as well as in case of installment sale. In the case of a hire purchase and installment sale, what is done is a buyer purchases goods but pays the price of the goods in various installments. So in both hire purchase as well as installment sale, the possession of the property is transferred to the buyer, but the seller receives the money in various installments. So the buyer takes possession of the goods and starts using them, though he has not paid the full price. The person who purchases such goods on hire purchase basis is called the hirer. The person who is selling such goods is called the hire purchase seller, also known as the hire purchase vendor. And for taking care of the sale and purchase, there is an agreement entered into between the seller and the buyer, which is known as the HP agreement, that is hire purchase agreement. It must be in writing and must include the description of the goods, that is whatever is the goods sold by the seller to the buyer, what is the price at which it has been sold, what is the interest to be charged for the finance made available to the purchaser, and what are the number of installments when they are payable, etc. All these are stated in the hire purchase agreement. Normally, the practice is to recover a certain portion of the value of the asset in cash, which is known as a down payment. Normally, most of them are with a down payment of say between 10 to 20%, and the remaining amount is converted into installments after including the interest payable on the amount. So, though both of them are alike as far as purchase is concerned and payment received is concerned, there are certain differences between the two. Let us try to understand the distinction between the hire purchase and the installment sale. In respect of the ownership, let us try to find out what is the difference between HP and installment sale. In the case of hire purchase, the ownership passes to the buyer on payment of last installment. That means though the buyer gets possession of the asset, the ownership continues with the seller of the goods. It does not pass to the buyer. Whereas in the case of installment sale, the ownership passes immediately as soon as the transaction of installment sale is completed. That means as soon as the sale is completed, as soon as the possession is given to the buyer, the ownership also gets passed on to the buyer. Therefore, because ownership passing on is different in two cases, the seller's right on default in payment of installment will be different. In the case of the hire purchase, since the ownership continues with the seller, seller can take back the possession of the goods. Since he is the owner, he can always go and take back the possession of the goods. Whereas in the case of installment sale, as the ownership is already passed to the buyer, seller cannot take back the goods. He can only sue the buyer for non-payment. That means he can only take recourse to legal action. He cannot forcibly take the possession of the goods. And similarly, in respect of buyer's right, again they will definitely change, because in one case the ownership has passed on, in another case ownership has not passed on. So, in respect of the buyer's right to terminate contract, in the case of a hire purchase, since the ownership continues with the seller, buyer has the option to terminate the contract and return the goods. That means the purchaser can any time decide to return the goods and terminate the contract. Whereas in the case of installment sale, the buyer has already got ownership of the property. He has no right to terminate the contract. Whether or not he wants to terminate or not, he has no right to terminate the contract. And next point is buyer's right to dispose of goods. In the first case, buyer has no right to dispose of the goods as the ownership has not passed to him. Therefore, in the case of hire purchase, owner cannot do anything, only he can return the goods to the seller. Whereas in the case of installment sale, buyer is the owner of the goods. Though he has not paid the installment, he can still dispose of the goods as he thinks fit. And in the respect of loss of goods, loss has to be borne by the seller, because the ownership is with the seller in case of hire purchase, and on the condition that the buyer has taken reasonable care of the goods. If the buyer has not taken reasonable care of the goods, then ultimately buyer becomes liable for making good the loss on account of the loss of the goods. Whereas in the case of installment sale, buyer has to bear any loss of goods. The ownership is already with the buyer. So if the goods are lost, the entire loss is to the account of the buyer. Now let us think of the accounting entries which can be passed in the books of the hire purchaser. So as soon as the purchase of the asset is made by the hire purchaser, that means the seller purchases the asset first, then in that case he has to debit the concerned asset account. Suppose let us say he has purchased an air conditioner. So air conditioner account will be debited and it will be credited to hire vendor account, that is the cost price of the asset. Then the hire vendor account is debited and the bank account is credited whenever there is a down payment made. And when the interest is payable at the end of the first year, then interest account is debited and it is credited to hire vendor account. This is in the books of the hire purchaser. And when the amount of first installment paid, again hire vendor account is debited and bank account is credited. When depreciation on the asset is provided, then depreciation account is debited asset account is credited, and ultimately depreciation and interest have to be transferred to the profit and loss account. Therefore, profit and loss account is debited by crediting interest account and depreciation account. Now, let us consider the accounting entries in the books of the hire vendor. First of all, he will debit the hire purchasers account and credit sales account, because that is the sale of assets on hire purchase basis. So, sales account become an item of income in the books of the hire vendor. When the interest is charged for the year, then that also is debited to the hire purchases account, because ultimately that money has to be recovered from the hire purchaser and interest account is credited. So, interest also become an item of income in the books of the hire vendor. So, when the installment is received, then obviously bank account is debited and hire purchaser's account is credited. That means the liability of the hire purchaser goes down by crediting the amount of installment in his account. And when interest is transferred to P&L account, because it is an item of income, interest account is debited and profit and loss account is credited with the amount of interest.